the other outcome would be the outcome you've shown me. But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin's price action, was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything. But
Raoul Pal, the founder and CEO of Genuine Vision, has frequently emphasized the connection between the success of cryptocurrencies and the global M2 wide money supply liquidity circumstances. Pal highlights that when global M2 growth picks up speed, financial markets benefit from increased liquidity, which lowers risk on assets like cryptocurrencies, which are extremely sensitive to liquidity. While cryptocurrencies frequently move in lockstep with stocks, especially tech stocks, Bitcoin, and other digital assets typically do well when central banks and governments infuse money into the system through measures like fiscal stimulus or quantitative easing. Pal contends that because cryptocurrency draws speculative investors, it can decouple and outperform during times of severe liquidity or financial hardship. The cryptocurrency market has been performing marginally below expectations recently, according to capital seeking high return opportunities. Pal attributes this underperformance to the US dollar's current strength and says it cannot be allowed to continue as it puts the global economy and all financial markets at risk. Pal says that major economies might be forced to refinance their debts, which would increase global liquidity. He thinks that this, along with President-elect Donald Trump's wish for the dollar to weaken, will force the Federal Reserve to quickly change course in the upcoming weeks, pumping liquidity through a variety of channels to support the markets and the U.S. and global economies as a whole. We'll show you snippets from Pal's most recent interview with Andreas Stenos Larson of Real Visions, in which he talks about his predictions for monetary policy in 2025, the effect of cryptocurrency prices, and Trump's economic approach. Please see it through to the conclusion. Please subscribe to the channel, and enable post alerts for future videos like this one. Your actions greatly aid the channel's growth and the YouTube algorithm. Thank you, and have fun with the video.
When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up, and once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know. Now, the other outcome would be the outcome you've shown me. But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin's price action, was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything, but it's either your outcome, which is a sharper fall for longer, in which case it's fully mirroring the M2 drop, or it does what it did last time, which is it prices in the first part of the M2 drop and then dislocates, and it tends to dislocate the rest of the year because there's more speculative flows in the final year. Liquidity should come in. So that's my view. Yes, there's nobody's withdrawing liquidity except the Fed, which is the dollar issue, right? And so even though, I mean, the Fed have been neutral with liquidity, but the dollar's got stronger. So dollar liquidity in the system is the issue. As you rightly say, nobody else is withdrawing liquidity. Everybody's trying to add liquidity. But the dollar is kind of overwhelms everything right now.
Yeah.
It is and isn't. The one thing I am looking at is it has been the canary in the coal mine for the bond market. The UK seems to have the worst liquidity of all of the major bond markets. And if I look at on Bloomberg, the gilt liquidity index, it is now continually trading higher than the Liz Truss, gilt intervention. So it cannot be escaping the central banks that inflation expectations are stable, and yet yields are exploding higher. And again, right in your wheelhouse, it is telling you, screaming at you, there is not enough liquidity. Now,
Yeah.
and understand they're scared because they've just gone through that inflation episode and everybody's still angry about it and whatever. So they're reticent to do something. So they're trying to hold on as long as possible before injecting liquidity. But politics will trump all, and US politics is the big daddy of it all. And the US needs to add liquidity because they're about to have the debt ceiling shut down, and they're going to and Trump has got to show markets going up, people are happy, all of that. And we know how to do that. It's simple. Just jam the pedal on the accelerator with liquidity and everybody's a winner.
Julian Bid is the chief of global macro research at global macro investor Raoul Pal, a monthly advisory journal that offers investors comprehensive global macro data and practical trading advice. His examination of how macro and crypto cross is somewhat comparable to Pal's recent piece on X. Julian talks about the dollar wrecking ball and how he thinks it will peak in the upcoming weeks. The tweet reads, "The dollar wrecking ball is in full swing here. The dollar's rapid rise over the past couple of months has massively tightened financial conditions. This sharp move is already taking a toll on U.S. economic surprises. Economic surprises have already pulled back from their peak levels in November and are likely to continue drifting lower over the near term. In other words, this is exactly the kind of impact we'd expect from such a rapid tightening in financial conditions." Julian goes on to say that while this negative news may last for a little while longer, it will eventually make way for the good news. The rest of the post reads, "This setup is exactly what I believe will pave the way for the Fed to step in and begin easing rates further soon despite the prevailing narrative floating around for zero cuts in 20,125 and the forward curve currently pricing in just 28 basis points for the whole year. However, the conditions for a shift towards easing are already falling into place. So here's how I see it playing out. The dollar and yield surged in Q4, creating a significant tightening in liquidity conditions. Now with the lag effect kicking in, weaker economic surprises are emerging. And as those continue to deteriorate, the Fed will have no choice but to respond. When that happens, we're likely to see the dollar's strength finally capped and the pressure from rising yields start to ease. This will then help alleviate the liquidity squeeze that's been building, giving risk assets the breathing room they need to rally again." During the discussion with Raoul Pal, also talks about the aftermath of this expected liquidity boom, especially given that the inflation battle has not been completely done. Here are further video snippets.
I don't think liquidity affects inflation, really. I think they're driven by different things. You know, one is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same things. A lot of this is also the year-on-year base effect.
Mm.
So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data, but you know, anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic, and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time.
The cycle is improving.
So here's a question for you,
Yeah.
because we look at this a lot. Why has the ISM been so low for so long? has been, there's only a few times in history that it's spent this long below 50. 2001, 2, 3, eventually it came out. And like you, all our forward-looking indicators say it's going to explode out the blocks eventually.
Yes.
And then I can't remember when the prior time was, 1982 or something. So it's only ever done it a couple of times. Do we think it's to do with because rates stayed so long that it's bifurcated the economy between those who don't need interest rates? It's great for Microsoft because they have tons of cash, but it's terrible for the local restaurant business or whatever it is, the construction business that requires it. What's causing it in your mind? The other thing that a low ISM indicates to you is that household earnings and corporate earnings outside of the tech are somewhat stagnant still, right? So the feedback loop we haven't had yet, even though the economy has been growing at decent clip. The actual broadening out of economic growth with recycled earnings and profits hasn't really happened. So it's a very late cycle in that respect. And the moment it does, it means that the structure of markets changes, small caps start doing better, alt season happens in crypto, it's all the same risk curve. Junk outperforms, all of this stuff starts happening the moment that happens. And we're still not there because of Fed rates, I think. I agree. Everything we look at, I've just been surprised that the ISM has not followed the forward-looking indicators yet. But it feels like any month now, as you say, it's going to be up 6 index points and another 6. And then before you know it, you're in the mid-50s. And then you'll start to see it. And I think, obviously the Trump administration want that too, because they can't just be tech stocks that are winning. They want Main Street to win as well. And Trump, in the end, is a property developer. He understands the business cycle as well as anybody.
While some predict prices could drop more precipitously as the correction continues before the recovery phase starts, Pal believes that Bitcoin and other cryptocurrencies will continue to chop around their present levels for a few more weeks. According to Tom, the head of research at Fundstrat Capital, the price of Bitcoin may drop as low as $50,000 before it starts to rally back up. Lee reveals in a recent interview with CNBC that the price of Bitcoin is currently down by around 15%. Peaks a scenario he characterizes as a fairly typical correction for an extremely volatile asset. But Lee notes that the market is still in the early stages of the current Bitcoin cycle, which means prices might fall in the upcoming weeks. He predicts a possible decline to $70,000, then he claims that investors will have a great chance to purchase the drop before the second phase of the rise starts, possibly even at $50,000. In addition to leaving your thoughts and observations in the comment section below, please make sure you like this video, subscribe to the channel, and enable post notifications for more videos like this. Thank you for watching. Do you agree with Pal's slow burn correction predictions or Lee's rapid drop correction? Or do you think the cycle has already peaked and we won't see another Bitcoin all-time high in 2025?